So Dan, do you want to count Mike down so he knows when to?
Sure. So okay, sure. So I'll just do a 3, 2, 1 here. So 3,
yeah, please.
2, 1, go.
Good morning, everyone. On behalf of TD Bank and our partner, the town of Orangeville, I'd like to welcome everyone to this year's Economic Summit Outlook. I would like to begin by acknowledging that the land on which we gather is the traditional territory of the Anishinaabe people, including the Ojibwe, Potawatomi, and Odawa of the Three Fires Confederacy. My name is Mike Gruby, Area Manager at TD Bank Business Banking, and on behalf of my colleagues and business partners, we are very pleased to again support the town's annual Economic Outlook Summit and the business development activities of the Orangeville and Area Small Business Enterprise Center. Despite the challenges brought by the pandemic, the Small Business Enterprise Center was able to pivot their services online for the past 2 years to continue to provide seamless service for our region's business community. The SBEC provides business counseling advice, business registration assistance, mentorship, referrals, entrepreneurship training, and many more services for people wanting to start, expand, or start a business locally. You know, over the past 19 months, small businesses have proven time and again how resilient they are, pivoting their businesses to adapt to changes beyond their control. Business owners in our community feel an incredible sense of pride of their accomplishments over the past few months and have shown their passion, skill, and commitment is as good as any community. TD Bank's commitment to diversity and inclusion is not only core to who we are, it's critical to our business success. At TD Bank, we know that our greatest asset is our people. That's why our mission is to cultivate a service-oriented, barrier-free culture that attracts, invests in, and promotes all talent, reflecting the diverse communities we serve. Throughout the pandemic, our account managers have been there to help guide businesses through the different stages and will continue to do so in the future. This is the second year that we bring the annual Economic Outlook Summit to you virtually. And this morning, you'll hear about the latest economic trends influencing the globe, our country, our province, and our local community. Now, I'm very pleased to introduce Charlene Glover, Account Manager Small Business with TD Bank, who will be our MC today's event. Over to you, Charlene.
Well, thank you, Mike. I appreciate everyone being here today, and good morning. My name is Charlene Glover. I am the Account Manager for TD Small Business Banking, covering Orangeville and surrounding area. It is my pleasure to be here with you again as your MC, and I thank you all for joining us this morning. Today, we're happy to welcome back James Markle, Managing Director and Senior Economist at TD. We also look forward to hearing from local business owner Perry Meeker, who will share his experiences of managing a hospitality business during the COVID-19 pandemic. Before we get started this morning, I'd like to give you an overview of how the presentation will take place and go over some housekeeping details. The event is being broadcasted live on YouTube and will be recorded. We are inviting audience participation through the monitored chat box, which you can access at the right side of your screen. Excuse me. In order to post to the chat, you must be logged into your YouTube account. Please use the chat box to post your comments or questions for either of our presenters at any time throughout the presentations. Following both Mr. Markle's and Mr. Meeker's address, there will be time for a Q&A period. Now it is my pleasure to welcome Orangeville Mayor Sandy Brown to bring greetings on behalf of the town of Orangeville. Welcome, Sandy.
Thank you, Charlene. On behalf of the town of Orangeville, I'd like to welcome everyone to our annual Economic Outlook Summit. Due to the ongoing pandemic, we're pleased to be offering the summit virtually again this year and to be co-hosting this morning's event with our partner, the TD Bank. TD is a strong supporter of our community and its businesses, and we are pleased to have such a productive relationship with the bank. Thank you, TD, for supporting our business development efforts. The town is also supported by its Business and Economic Development Advisory Committee. I'd like to recognize our volunteers for the 2019-2022 term, including BDAC Chair, Councillor Joe Andrews, along with members Buddy Pitt, Wendy Edwards, Paul Cervini, Linda Horn, Troy Brett, and Diana Morris. Thank you all. I'd also like to take this opportunity to acknowledge the late Pete Renshaw. Pete was the vice chair of the BDAC committee prior to his passing earlier this year. Pete was a very active member of the local economic development community, and the entire economic development team, along with all of council, are grateful for the many contributions that Pete made to our community. Small and medium-sized businesses are the backbone of our community and our economy, accounting for 99% of all Canadian companies and employing about 89% of private sector workers. More than 2,500 businesses are operating in Orangeville, and these operations employ more than 11,000 people. These businesses create jobs, they create diverse revenue streams, and they support other businesses by buying local. The past 2 years have brought unprecedented challenge and upheaval for municipalities across Canada, yet despite the hurdles presented by the global pandemic, our local businesses continue to demonstrate incredible resiliency. The total number of businesses operating within Orangeville declined by only 1% between 2019 and 2020, and these business closures were balanced out by growth in the construction, services, real estate, and educational sectors. The town has been diligent in its efforts to bring you the latest news, incentives, recovery resources, virtual learning opportunities, and other help as our business owners work to operate during the pandemic. An award-winning COVID-19 recovery plan was developed and implemented, and it included focused efforts to support the business, tourism, and cultural sectors in our community in the short and long term. While the plan continued to guide our recovery from the pandemic, the town remains adaptable and ready to seize any new opportunities with our federal and provincial partners that will support the recovery, maintenance, and growth of our businesses. Over this past year and a half, the Economic Development Culture Division has continued to offer existing programs while also modifying, adding, and adapting services as needed. And our council continues to examine new ways of conducting business and bringing efficiencies to our businesses and residents, adopting smart technology projects, adapting bylaws and practices to fit our reality, and investing in projects that will support our economic recovery and growth. I'd also like to acknowledge Ruth Phillips, the town's manager of economic development and culture. Ruth and her team have been very busy over the past couple of years advising businesses and our cultural leaders as they navigate government programs to assist during the pandemic. It was business as usual for the economic development team and then some. Again, on behalf of Orangeville Town Council, I'm very pleased to welcome you today. And like you, I look forward to learning about the economic forecast for the upcoming year. I hope you'll all enjoy this morning's presentations. Back to you, Charlene. Thank you.
Thank you very much, Sandy Brown. It's a pleasure to have you today, joining us and everyone here with us today. It is with great pleasure that I now introduce you to this morning's keynote speaker, James Marple, Director and Senior Economist at TD. As a respected commentator, James gives presentations and is frequently interviewed by various media outlets across North America, speaking on economic and financial trends. Many of his presentations these days are actually virtual. So today, James is joining us. James has been an economist with TD for 14 years, and in his current role, he works with a team of experts to provide analysis and forecasts for the global economy with a focus on North America. He holds an Honour Bachelor of Arts degree in Economics from the University of Alberta and a Master of Arts degree in Economics from the University of Toronto. Prior to joining TD Bank Financial Group, James worked as an economist for the Ontario Ministry of Finance. And today he currently serves on the board of the Toronto Association for Business and Economics. Please join me in welcoming James Marple with us today. Off to you, James.
Thank you very much, Charlene. I will just share my screen here and we'll be good to go. Okay, so thanks again for having me. I do hope that one day we return to in-person events. I miss seeing all your faces, and I have been up there in Orangeville for I think the year before last, before we went virtual. So hopefully, fingers crossed, we're back there again next year. We've entered I'd say a more interesting and perhaps precarious stage of the economic outlook. Certainly the health crisis is still very much with us, but it does look like we're getting closer to the end of it, especially with vaccine rollouts. We have had that rather than strict lockdowns, jurisdictions have moved toward things like vaccine passports and vaccine mandates. That has imposed some restrictions on activity, but less than full-scale lockdowns. So we have still allowed economic activity to continue, but we're seeing the limitations of some of those in terms of fully moving back to normal, especially in the sectors that have been the hardest hit, of course, leisure and hospitality, accommodation and food services that are still very much operating in deficit relative to where they were prior to the pandemic. Just a step back to think about our outlook globally, we have in our most recent forecast downgraded slightly the economic outlook. There are two factors behind that. One was obviously the Delta wave of the virus, which has gone around the world, but especially in the United States and in Southeast Asia. That has contributed to the other factor that's really been slowing economic progress, and I'll probably talk a lot more about over the course of the presentation, but that is issues in supply chains and just on the supply side of the economy, that as much as maybe there's demand there to support growth, we don't have the productive capacity to meet that demand, and that's increasingly been a serious issue. And of course, we've had that show up in higher inflation and worries that we're entering into a stagflationary phase of the pandemic or the economic outlook. And so I would like to talk a little bit more about that risk and our thinking on it. I think the good news first, as I mentioned, is we look like we're through what is now the fourth wave of the pandemic. We have seen very recently a little bit of an uptick in new cases, but certainly in Canada, we continue to see cases trend down. In Ontario, the numbers look relatively good, and we continue to move toward economic reopening. There are obviously some risks on the horizon with respect to the health outlook, just to the fact that the weather is getting colder. We also know that some of the vaccine protection tends to wear off over time, and boosters will likely be necessary. We also now are starting, will likely in the next few weeks begin vaccinating younger children, which should be helpful in avoiding increases in cases among that population, especially now, obviously, as schools are reopened. For Canada, the risks are perhaps a little bit more acute than in other countries, especially in Ontario, where hospital capacity is an issue. When cases, we have a much lower threshold in terms of the level of cases before measures are taken to public health measures are taken that obviously have economic implications that we have not seen to the same extent in other countries. And obviously that's something that we just have to watch very carefully. Our assumption right now is that we don't see any step backward in terms of the economic reopening plan, but that's obviously something that we have to just continue to monitor, and we know, I guess, as much as anyone else in terms of how that is going to play out. Of course, on the vaccination front, I think the really good news for Canada and for Ontario is that we are well ahead of most of the rest of the world in terms of the vaccination rates. We have the vast majority of adults with two doses, and we have vulnerable populations, especially the older population, that has even higher rates of vaccination. And that goes a long way to breaking the link between the virus and the most severe outcomes, hospitalizations and death, which, of course, as I mentioned, lead to backtracking in terms of the economy. If those cases start to get high, we will likely again see some cases go up as vaccine effectiveness wanes. But I think that will be met with booster shots that I think we'll likely see in the next few weeks. So overall, the outlook for North America is productive going into next year. You do hear some negativity about what growth will look like over the next year, and part of that stagflation comment is this notion that we're going to see weak growth and higher inflation. And I think looking at the growth outlook, one, we have already seen pretty solid growth coming into this year. We did have a setback in the second quarter of the year with the fourth wave of the pandemic, but but economic data has pointed to a recovery into the final quarter of this year. And of course, we continue to see move toward greater economic reopening. Our expectation is some of the growth that we don't get this year due to some of the supply chain disruptions that we've seen, we should get next year as those are alleviated. And that means that we should continue to see an above trend rate of economic activity. We're continuing to be in recovery mode all the way through next year, which means we should get growth, well above the normal rate as we continue to move the economy back to normal. If we look across the country, in Canada, where we expect to see the strongest growth, it is Ontario that is expected to lead economic growth in 2022. That follows 2021, where Ontario has been a bit of a laggard. We were hit especially hard by the lockdowns that took place in the second quarter through the second quarter of this year, more stringent than in some of the other parts of the country, and the economic setback there was larger. But we've also seen now recovery that has been looking stronger than we've seen elsewhere, and we've had pretty good success in terms of managing the pandemic. That should show up in terms of a higher rate of growth next year, greater move towards normalcy, especially in the hardest hit sectors of the economy. If you look this year, BC and Quebec really led the recoveries, and there we expect to see a bit slower growth next year as they're just a little bit closer to normal. So for all the talk of some of the downside risks to growth, I think it's important to note that leading indicators, especially higher frequency indicators, continue to point to the resiliency of demand. So we continue to see both manufacturing indexes and service sector indexes that typically lead any change in the economic momentum continue to point to well above trend economic growth. I'm showing here data for the US, but we have slightly more limited data in Canada, but the data we do have point to very similar readings, that we're above trend in terms of what the here and now indicators of economic activity suggest. And that gives us some confidence that this recovery will continue. It's being held back more by on the supply side, which I'll talk a little bit more about. But I think important to look at is those underlying indicators of domestic demand, and that continue to support pretty strong economic growth. So one even source of potentially upside risk to consider is that over the course of the pandemic, obviously spending was unable to happen, and spending fell in both nominal and real volume terms over the course of the pandemic, especially on high contact service areas of the economy, where as we know, we're still 15 to 20% below levels of activity prior to the pandemic, and at the same time, income was supported by a series of government income supports, the CRB, as well as other, which morphed into the CRB, the recovery benefit, and these actually led income to rise above what we would have anticipated prior to the pandemic. So you had higher household income, lower spending, and as a result, we've seen the savings rate, the household savings rate, rise to an unprecedented high. When the initial lockdown happened, incomes were supported, people couldn't spend, the savings rate hit 25% of disposable income. It's since fallen back, but the most recent data we have for the second quarter of this year, the household savings rate was 14.2% of income. That leaves a lot of firepower to support spending going forward, especially if you consider that the 14.2%, that's a rate of savings. You actually have a stock of savings now, that there's a lot of potential spending, that a lot of potential income that should support spending as, again, we move toward more economic reopening. And that I think is a real positive for the outlook, because again, it's the underlying fuel for spending growth that we think should be enough to power the recovery going forward, as we especially as we move away from some of the constraints that we're currently seeing on economic activity. The other factor, of course, we have to build in, and we put our economic outlook together before the last election. We were watching, obviously, closely the outcome of that election and what parties were promising during the election campaign. And if we compare what was promised by the Liberal government, deficits in the near term expected to be larger than they were even at the last federal budget. Additional promises amount to $20 billion, excuse me. That's just shy of 1% of GDP. We have heard from the government that many of the income support programs that were in place will expire this year. And the deficit will decline next year. So the level of spending will decline. In some sense, that's a drag on economic activity, offset though by that accumulated savings that we've seen on the household side. And now if you sort of just consider the change relative to what we had built into our expectations, a little bit more spending even over the next several years than we had anticipated. Of course, that's only helpful if your economy is not constrained on the productive side of the economy, on the supply side, and increasingly that's where the challenges lie. So I want to talk a little bit more about some of those supply side challenges and hopefully how they are resolved over the next year. So I'm showing here data for the United States. Again, that's mostly just because we have long history, and it tells a similar story that we're seeing also in Canada. But there are sort of two ways of looking at the issue on the supply side. One is in terms of inventories of goods relative to sales. So businesses are running extremely low, lean levels of inventories, not because they want to, but just because the level of inventories are have decreased as we've seen production unable to meet demand. That's typically a good leading indicator. You don't typically get turns in the business cycle with such low levels of inventory. There's literally nothing to work off that you need to slow production. Instead, you need to ramp up production in order to rebuild inventories back to normal levels and obviously meet ongoing demand, which we believe will be pretty well supported. The other side of the story on the supply side is just what we're seeing in the labor market. And increasingly, we see levels of job openings and vacancies that are at record highs. And this is true in both Canada and the United States. If you look in Canada, we just put out a report on looking at the labor market and the increase in imbalances we've seen between demand for workers as represented by job vacancies and job openings, and the level of unemployed or the potential pool of workers that could be hired. And it would suggest that with the level of openings and the relationship between unemployment that we saw prior to the pandemic, we'd expect to see a much lower level of actual unemployment by that level of job openings, and that hasn't happened, and that reflects challenges we think in workers getting to jobs, and some of that probably is just the fact that the health crisis is still with us. There are jobs that are much more risky than they were prior to the pandemic to go back to. And when we look at where the deficits are, and I'll show that, the biggest deficits are, of course, in those higher contact service sectors where there just is more risk of exposure. And the other side of things is there's also now more onus on employees to maintain public health measures, and there's more stress related to that. And I think that's contributing to some of the issues on the supply side. Just to bring it back to Canada, one way of gauging sort of the challenges facing small and medium-sized businesses is just a survey that's conducted by the Canadian Federation of Independent Businesses, literally asking businesses, what are the factors affecting their ability to grow and maintain activity. And you really see a big change relative to prior to the pandemic, where almost all of, I mean, I've listed them in order here, in order of the change relative to 2019 prior to the pandemic. And the issues are import shortages, labor shortages, distribution constraints. And then on the other side, the other things that have gone down as challenges are things more on the demand side and the financial condition side of things, where those are not the challenges that they were prior to the pandemic. Again, just speaking to the argument that if we could work to getting through the health pandemic, the health crisis, I think some of these supply side challenges should also cease to be the impediments that they are, and that should allow activity to rebound at a bit of a faster rate. The area of the economy where you really have seen the impact of the supply challenges is in the auto sector. And of course, I'm sure you're all familiar with the shortages of microchips, which is really epicenter of that is in the auto sector, where production has had to have been curtailed in Ontario and elsewhere in the global supply chain due to a lack of microchips. If you look though at the underlying rate of sales we've seen, it has dipped relative to where it was prior to the pandemic. The level of sales, of auto sales in 2019 was running, in 2018 was running around the 2 million mark. It dipped to 1.6 million, of course, with that initial plunge when dealerships were closed at the in the lockdown in 2020, but rebounded. And now we've seen been weighed on by lack of inventory. But what that should mean is that there's a lot of potentially pent-up demand. If we look, the trend level of auto sales in Canada is probably something like 2 million annually. We've had 1.6 million in 2020, 1.7 million in 2021. That's 400,000 or so auto sales that could take place over the next few years, to make up for the depreciation and just the underlying growth in the population that would support that level of sales. So that is, I think, a pretty optimistic indicator, and why we expect to continue to see growth in that element, and obviously in production, which is important for Ontario as we rebound back to more normal levels, and even have to go further than that in order to replace those inventories. Okay, so one thing I think is important to recognize, an important nuance here that is different between the story in Canada and the United States. We hear a lot of what we hear on the news, I think, is just driven by the economic stories in the United States. But fascinatingly, the labor market is very different. In Canada, the last employment report showed that the level of employment in the country eclipsed its pre-pandemic level. There's some nuances there, but that is very different from what we've seen in the United States, where the level of employment is still 5 million or so below its pre-pandemic level. You also see that in terms of participation in the labor force, where in Canada we have had people at least engaged actively in the labor market, looking for work if they don't have work. And in the United States, we have seen that people are not even, saying that they're actively looking for work, so they're not even counted in the official unemployed. I mean, I think that implies that those challenges on the labor side are probably going to be worse in the U.S. But it also means that they have, if they can unlock that sort of shadow pool of labor, perhaps they have less challenges going forward than we're already starting to see in Canada. Underneath that labor story, though, I think is one really important nuance, and that's if you look at the sources of job growth by industry. In Canada, you see that it's not as widespread as one would like. The growth has come in professional and business services, jobs that can be done, professional services, especially actually business services, pardon me. And there is an important nuance there, professional services being sort of the accountants, lawyers, economists, jobs that can be done from home, and then the businesses that support that activity, which typically means office supports, the business services is still well down. The workers on the professional side of things are still there because they're able to work from home. But we've seen, growth in government employment, public admin in Canada, and then related to government education, health, and social assistance is up. And of course, finance, insurance, and real estate, which has benefited from the housing boom that we've had in Canada over the last year. But you see that the deficits in those higher contact service areas of the economy, especially accommodation and food services, still down 15% relative to its pre-pandemic peak. Other services encompass, dry cleaners, any kind of in-person services. A lot of those jobs are there, and they're still way below where they were prior to the pandemic. Construction may be somewhat surprising, although that encompasses all sorts of construction, not just residential. But you see that this gap, I think, explains some of the challenges that businesses are facing. I mean, there's capacity constraints, and there's an inability to attract workers back in some of those higher risk sectors, and that, I think, explains the continued supply challenges that we see. So if you put the two together, the fact that, I've told this story that underlying demand remains well supported. There's a large pool of savings that can support spending, and you have supply constrained. I mean, you put those two things together, buoyant demand, supply being limited, and it's not that surprising, that we've seen increases in the price level and an acceleration in the rate of inflation. The last data we had in Canada, the headline inflation rate hit 4.4%. I don't show the history back far enough here, but that's the fastest rate of consumer price inflation we've had in Canada since 2003. So it's an 18-year high. There are a couple of things that I think are important to recognize with the current rate of inflation. One is that when we compare year-on-year price growth, we're comparing to a period last year that was still in the in the throes of the pandemic or in the early stages of recovery. The economy was reopening by then, but you still had levels of, for example, gasoline and energy prices that were still well below their pre-pandemic level. And then over the past 12 months have just shot up and are now above, obviously well above their pre-pandemic level, but we're comparing to a low, which really tends to inflate the year-on-year measure. If we compare prices on an annualized basis to what they were in September of 2019, prices over the past 2 years on an annual average basis have gone up 2.4%, so not quite as high, and that just speaks to a bit of that level effect that was due to just the year-on-year comparison. But of course, the other thing we've seen is a rotation of demand toward goods, and where we've seen the biggest acceleration in prices is been in durable goods and autos. And now transportation, we've seen a normalization. So the third factor I think is important is that in areas that were depressed, they're now starting to come back. Many of them are capacity constrained, and they're starting to see higher input costs, and those have been passed on to consumers. So the outlook for inflation, I think, is pretty important, obviously, to the economic outlook. A lot of what we expect to see going forward depends on those supply constraints slowly being alleviated, but it also means that we can't continue to operate in an economy in excess demand territory where that's going to continue to push up. Pressure on prices. Sorry, I went a little bit too fast. So the first thing I think, just on the inflation front, is that if we are to see a bit of a rotation in the source of demand away from just goods, and especially we've seen that that's where a lot of the source of inflationary pressures are, because we've seen people unable to leave their homes, unable to travel to the same extent, or go to restaurants, shows, all of the ancillary businesses, a way they would spend if they could get out and act as they had prior to the health crisis, and that has turned into spending on things you can do from home, and that rotation. We should see that, where the deficits are, they start to decline, in the areas that are way over where they should be, that gap starts to close. That should help. That should help to lower some of the price pressures. But the other thing that I think has to happen is that we have to see the policy supports that were put in place to get us through the pandemic and that have been supportive of demand have to start to be pulled back, and we've seen that now on the fiscal side of things. We've also last week heard from the Bank of Canada, and they moved forward slightly their expectation for when they would begin raising their policy rate. I don't have a picture of the policy rate here. I have what we're showing is longer term bond yields, but those should respond to changes in the policy front from central banks. And the Bank of Canada now, we expect to see them over the course of next year, 2022, raise their policy rate by 75 basis points, likely beginning in the second quarter of the year. So that would bring the overnight rate from a basically zero. That's at 0.25% back up to 1%. Of course, the Bank of Canada already announced that they are ceasing their asset purchase program. They're entering a reinvestment phase, so they're not going to draw down yet the size of their balance sheet, but they're no longer going to purchase government bonds in a way that has helped to lower yields and contributed to, again, I think some of the demand side imbalances that we've seen. And that central bank response, I think, is just as important in eventually taming some of the inflationary pressures that we see in the economy right now. Now, higher interest rates will act as a drag on especially interest rate sensitive sectors of the economy. Perhaps the one that is most close to people's hearts and the one people can relate to the best is the housing market. And we have seen just an incredible activity in the housing market over the past year, 50-100% increase in the level of sales over Canada-wide. And really, I think what's fascinating is that it has been a nationwide phenomenon, that demand for housing has increased in all provinces. It's been especially strong in bedroom communities around major cities. People have the race for space has led to especially strong demand even in places like Orangeville and Dufferin, where we've seen even stronger growth and stronger home price growth, and that has obviously contributed to affordability challenges. We have seen more recently sales start to pull back, but markets remain extremely tight in terms of the level of inventories of homes for sale. And as a result, we've seen very little movement on the price front. And in fact, in more recent data, we have seen a reacceleration in home price growth. The thing that tends to slow the housing market more than anything else, more than any kind of regulatory measures, is just simply higher interest rates. And we will be looking at our forecast, obviously, for the housing market. We had been anticipating higher interest rates, and that's what sort of brings the level of sales back to what we believe is a more fundamentally supported level. But of course, I would say more downside risk if rates are to rise faster, perhaps due to some of those inflationary worries. And we've seen now the Bank of Canada concerned about them and willing to act to slow them. That obviously presents some downside risk to an area of the economy that really has been supported by the change in policy in the other direction. The other thing in the housing market I think that we may see over the next year is after seeing really this race for space and move out of major urban centers that we're starting to see. That has led to obviously faster home price growth among single family homes, larger homes relative to condos, and that has shifted the economics back to condos in some sense, and we think that will lead to an increasing share. And at the same time, we are likely to see some of the exodus from major urban centers reverse a little bit as we get back to a more normal world where the amenities of living in an urban center are normalized, and that could lead to a bit of a less demand for single family relative to condos over the course of the next year. So that does it for my economic outlook. Charlene, if there are questions, I'll be happy to take them. Okay.
Sorry, I should unmute myself. We do have some questions here, James. However, they didn't come through YouTube. They came through all of my social media devices while you were going. So thank you so much for your presentation. The first question I have here is in regards to the automotive sales. So you mentioned that chip shortages are severely hampering auto sales. When do you see the supply of automobiles intersecting with the true demand? And true is in quotation.
Yeah, that's a really great question. We watch sort of the production schedules of the automakers quite closely. That's kind of one of the leading indicators. We can sort of see what they have supply chain experts and are perhaps even better equipped than us looking just at the data. And they are expecting that over the next several months, they should be able to have some of those shortages resolved and re-up their production levels. And you can see that's what we've embedded in our forecast in terms of by the first quarter of next year, we still have a lower level of sales, but that continues to ramp up over the course of the year. I would just caveat that by saying that automakers themselves have had to continually revise their planning and have been, optimistic perhaps and have had setbacks. And the challenge there is that, of course, these are real global supply chains. And what we've seen is often increases in cases in the pandemic in Asia have actually worsened some of those shortages. They've led to, there were shortages of microchip production in Japan due to increasing COVID cases. In China, where they have a strategy of zero COVID, they've shut down ports. And of course, that there's been a bit of a hoarding everywhere in the world where everyone wants to get chips and up production, and that has been set back. So I don't have a very clear crystal ball on that. I think obviously everyone's working toward the same goal, but it is difficult to say with a lot of certainty when some of these supply constraints will be alleviated.
So I appreciate that feedback. I do have a couple questions here on YouTube. James, with supply chain issues still an issue for the foreseeable future in a number of sectors, what do you anticipate the economic impact could be over the next 18 to 24 months?
Yeah, well, I sort of just kind of talked through that a little bit in terms of the auto sector. I mean, I think our base case assumption or belief is that we have started to see actually nascent evidence of this, that especially with respect to global trade, some of the container shortages and the real increase in the cost of shipping have started to come down. We've seen reactions like in the United States, in the port of San Francisco and the port of Long Beach, where they're really trying to run those 24/7. They're trying to deal with some of the other kinks in the supply chain, shortages of drivers, which are also contributing to some of those transportation shortages. I mean, there is evidence of progress to resolving some of those things. But obviously, as you saw in the presentation, I mean, our expectation is that over the next 6 months, 6-7 months, we expect to be in a bit of a different world, that we're moving away from a supply constrained world to one that is also normalizing. And key to that is obviously continued progress on the health front, that we continue to see the rates of vaccination rise, especially in not only in advanced economies where we're pretty much there, but in emerging markets, and if we can get further past the public health crisis, it should go a long way to, I think, resolving some of those challenges. But again, I mean, it is difficult to say exactly how long they last, or if there is another part of the supply chain that no one's even really thought of yet, where the next kink is.
Yeah, no, for sure. You did touch point on that a few times, and each industry is a little bit different, but absolutely, as long as we're seeing an upward trend. I do have another question here. It's in regards to gas prices. Where do you see gas prices in 1 year from now, and what will that do or impact commuters? How do you think that'll impact commuters?
Yeah, well, our expectation, obviously, for gas prices is driven in part by our expectation for oil prices, and we do think that the price of oil a year from now will be lower than it is today. So that should mean that the price at the pump is lower next year than it is right now. I mean, that's actually something that should contribute to a slower rate of consumer price inflation overall. I mean, gasoline is adding a percentage point itself to the consumer price index. So yeah, I mean, that's a very good question. I don't have the exact number in front of me. I would say lower, and if you want to know our exact forecast, we publish it on our website for oil, and you can kind of look at the percent change there. From where we are today to what we expect by the midpoint of next year. I think we're somewhere like $65 a barrel, but I can't recall the exact number. But anyway, I mean, that should carry through to gasoline prices, and should mean a lower price at the pump. And that's based on, the supply demand dynamics there, where we're starting to see, again, more production even in North America due to the higher price. And obviously, I mean, some of it's going to depend on what we have OPEC responding, but at higher prices, and when they start to see evidence that it's crimping demand, we do tend to see they increase production in order to not have prices move too high.
Absolutely. I think we'd all appreciate gas prices going down. The next question here is in regards to housing prices. As you stated, like housing prices, well, do you ever see that there's going to be any kind of mild correction with how high the prices are today?
Yeah, I mean, you saw our forecast there. That was Canada. I mean, it's pretty similar for Ontario, and we don't get that much more granular than that. But I would say there's, we have a flat profile, which is a very different growth environment from what we've had. So we're moving from I showed that chart in level terms. So we're moving from a 15% growth environment year on year to something like 0. So I would say that is going to take some of, I mean, that's in part due to the tightening in financial conditions and higher mortgage rates, and the affordability constraints that are really slowing the rate of price growth. But if you look at the underlying supply demand dynamics, the reason we have not built in much of a correction is just that markets remain very tight, and nowhere more is that more true than in Southern Ontario and the Greater Toronto area, where we just don't have a lot of inventory, and where we have for several years populations have been growing faster than growth in the housing stock and in housing construction, where we've underbuilt relative to, we've had population growth that prior to the pandemic was running close to 3% annually, and we weren't building nearly that many homes. So the population growth really slowed. Obviously, immigration flows slowed during the pandemic, but targets, the federal government has targets to make up for that with higher levels of immigration in the future. We expect to see some normalization in population growth, and that really, I think, puts a floor under where home prices could go to, because we just have now actually, in some sense, an acceleration in demand, even if we remove some of the froth in terms of interest rates.
Very interesting. Thank you. We have 2 more questions here. We have someone that's interested in your thoughts on the stock markets over the next year and some sectors that likely might be strong.
Well, if I was really good at predicting the stock market, I wouldn't be still doing this job and be on my yacht somewhere. So I don't. We tend not to have. We don't do direct forecasts for stock prices. I mean, I think our outlook, I would say, is a little more, take a very macro view and say that probably the rate of increase we've seen recently is likely to slow. And that's in part just as we see rising interest rates. It tends to be something that, you know, just in terms of discounting future profits you tend to see slower price growth. Of course, we still have a recovering economy. We still have above trend economic growth, even in a higher interest rate environment, and that should support financial asset values. So, I mean, I again, kind of like housing, I wouldn't say we're likely to see a correction as long as the business cycle doesn't turn, and we don't see any real evidence of that. But yeah, I'm not unfortunately not a great stock analyst, so I don't have any more opinions other than that.
Only we can predict the stock market. With the push for net zero carbon emissions, what impact would this have on the Canadian economy, particularly out west?
That's a very good question. Yeah, I mean, this is, I think, if we're thinking a little bit further out, you know, the next decade, this is going to be the primary theme driving economic activity, and it could go, you know, one of two ways. I mean, if we don't get the transition right, if we don't have the support measures right to transition away from traditional, you know, fossil fuel production toward, you know, green energy and electrification, and, you know, moving toward electric vehicle production and things where Canada perhaps does have some, you know, we're integrated into the North American supply chain and maybe have some competitive advantages. But if we don't get that right, it's going to be costly economically, and definitely those costs will be disproportionately borne by the traditional energy producing sectors in Alberta and Saskatchewan. So you know, there are some policy supports that can be made to alleviate that challenge, but yeah, I would say that it will be difficult for some of those economies that have really seen strong growth when energy prices were high and production could advance. I mean, you're already seeing it there in terms of investment that has really slowed in those sectors of the economy, and you know, there's still going to be a transition, and while there's that transition, there's demand for obviously for natural gas, especially as it's a cleaner fuel source than coal, for example. But yeah, I would say that we don't have a great crystal ball on that, but on the margin, it's going to require the right investments in order to continue to be economically prosperous through the energy transition.
Okay. Excellent, thank you. We do have one more question just to wrap it up, I think. It's kind of a two-part question. You showed a significant increase in inflation for the end of 2021 in your presentation. First part is, where do you see inflation trending into 2022 and beyond? When does Bank of Canada make its first interest rate adjustment? And where do you see interest rates in 12 to 14 months from now?
Okay, well, that's easy because I answered that one in the presentation, and I didn't specify where we see inflation going, but our expectation is that inflation in the next few months probably remains pretty close to the high we've seen, you know, 4.5%. We think at least for the next 3 or 4 months, those kind of rates are likely to stick around, but over the next 12 months, we do expect to see inflation move toward 2% by the end of next year. So we have slightly above a 2% inflation rate. You know, if we're looking a year out from now, where we see in September of 2022, we do expect it to decelerate. Some of that is what we see on the energy side. Some of it is the alleviation of some of those supply chains. Some of it is the reorientation of demand away from some of the goods sectors that are really pushing up inflation towards services. And of course, some of it is what we expect from the Bank of Canada. And on that, I mentioned we have moved forward our expectation for the first interest rate hike from the Bank of Canada to the second quarter of next year. And we expect 3 hikes before the end of the year. So that would take the overnight rate to 1%. We expect over the next 6 months or so the 10-year yield to rise by 50 basis points. similar increase in the sort of 5-year space. So that means fixed rate mortgage is likely to continue to move higher from the increases we've seen recently.
Fantastic. Well, thank you so much, James, for answering those questions for us today. We do appreciate your time. Your presentations always amaze me on how visually they spark so much attention to detail with facts, historical data, and future trends. So again, we are pleased that you could join us today online and bring your expertise to our Economic Outlook Summit. And we thank you so much for joining us today.
Thank you.
I'd now like to introduce one of our local entrepreneurs, Perry Meeker. Perry is a longtime entrepreneur who has been actively involved with the business community, serving many years as chair of the Orangeville Business Improvement Area and as a long-term director with the Dufferin Chamber of Commerce, which has now been rebranded as the Dufferin Board of Trade. Perry is also a licensed realtor with Remax Real Estate Center, and he serves the Headwaters region in residential, commercial, and industrial properties. In 1998, Perry opened The Hatter, a popular local pub located on Broadway. His business operated successfully out of this location until the building was destroyed by fire in February 2003. Perry persevered through this hardship and relocated his business into its current location at 101 First Street in 2004. Hailed as the oldest surviving family-owned restaurant in Orangeville, it has been a staple in the community for over 2 decades. The hospitality industry was hard hit by the onset of the pandemic. We're pleased to have Perry here with us today to share his experiences and lessons learned in managing a hospitality business during the COVID-19 pandemic. Please join me in welcoming Perry to today's presentation.
Thank you very much, Charlene. I'll just bring up my presentation here. I hope everybody could see that okay. The hospitality sector, as everybody knows, has been one of the hardest hit sectors during the COVID pandemic. If you could imagine, it has been a very difficult process for all of us in the hospitality industry, and as you'll see by our slides later on, that it is the hardest hit industry coming out of the COVID pandemic. A little bit about myself, Charlene kind of talked about it all. The first challenges that I faced for sure was the destruction of the building by fire in 2003. Moving to my current location where it is now, we opened at the end of 2004, beginning of 2005. And we have certainly faced a fair number of challenges inside of our industry. The least of which are profitability and income loss. Our cost of goods has increased substantially. The labor market has been reported widely inside and outside of our community. Everybody inside of the hospitality industry is struggling with labor concerns. We obviously have long-term and short-term debt issues now that many of us didn't have before the pandemic. We have physical limitations inside of our space. And technology has now become a concern for most of us. And then, of course, we come down to the customer. So profitability and loss of income. These are the sad numbers inside of the hospitality industry. These numbers were generated from our friends at the Ontario Restaurant, Hotel and Motel Association. And I'd like to really thank Tony Elenis for helping me out with these numbers, who is the president of the association. Full service restaurants ending in the year December 2020 were down 39.85%. Full service restaurants most of them do not have alcohol service associated with them. Limited service eating places are places like McDonald's and Burger King. Obviously, you see the numbers. They weren't down nearly as much as the other areas. Special food services, which are the caterers and the golf courses of our community. Obviously, with golf courses being closed, they were down a significant portion. Drinking places, beverage alcohol. Sadly, that's my sector. And we were down a whopping 56.36%. The total overall sector was down 29.07% year ending December 2020. So it got a little bit more optimistic. The latest numbers that we could obtain were from July of 2021. Full service restaurants were increased substantially, down only 0.66%. Limited service eating places, the McDonald's again, were up by a whopping 12.55%. Special food services had a slight comeback with golf courses opening back up, down 16.37%. And my sector down still a whopping 28.45%. Total sector loss was up because limited service eating places provided a significant portion of the increase in the sector. The awful stats inside of the industry: 80% of restaurants either broke even or lost money. 60% operated at a loss, 20% broke even, and 10,000 restaurants have actually closed during the pandemic. The reason why restaurants operated at a loss was because many of them chose to offer takeout, and quite often operating as a takeout only model, many of them simply just didn't have the wherewithal and had to operate at a loss to succeed. Income and profitability. Key takeaways on this are that this year we're expecting an 11.8% increase, but we're still going to be down 20% below pre-COVID sales. In 2022, the expectation is 21.6% increase over 2021, but still 3% below 2019. In 2023, we're expecting an increase of 5.3%, which gives us a profitability over the year of 2019 by only 2%. So it is going to be a long and slow recovery for the commercial food services sales in Canada, and this is the expectations that are set up from the Canadian Restaurant Association. The cost of doing business has also increased tremendously. Our cost of goods has risen tremendously, and industry profits are at an all-time low. I can give you a couple of examples. We used to be able to buy a nice 10-ounce strip loin, prepackaged center cut, and we could get that for about $12. That cost now has risen to $20. Our cooking oil is now almost 3 times the value of it was prior to the pandemic. Our insurance costs, if you can get insurance, many of our hospitality partners are telling me that their insurance companies won't renew their insurance, and they're having to scramble to obtain new insurance coverage, sometimes doubling, sometimes tripling the cost of what they were paying before. Product availability is at an all-time low. Chicken wings, which are a staple in our industry, actually at one time had such a scarcity that we had to move to outside suppliers just in order to be able to find them to sell. And of course, the costs associated with them are absolutely astronomical now. Everybody has heard about the labor market inside of the hospitality industry. The hospitality industry employs many new students, many people coming into a job for the very first time. And a lot of those people have missed out on this opportunity because we've been closed for 18 months. So we are experiencing a low with respect to first-time people being added to the industry. Many of the people during the pandemic had to find employment elsewhere, so they've completely left the industry. The problem with that is that we've lost many of our skilled labor inside of the industry. The hospitality industry has always had long hours, and it's always been a fairly low-paying job. Front house staff obviously depend on tips, and the back house staff has usually been paid minimum wage, or we have obviously paid higher for skilled labor like chefs. It's a part-time industry for many. A part of the problem, and we'll get into the skilled labor obviously is in demand, and it's a huge shortage of chefs. Many chefs have left the industry to go work 9 to 5, and they actually discovered that they like 9 to 5 better than working all their weekends all the time. CERB, everybody's heard that CERB has killed the hospitality industry. I would say that that's not exactly the case. CERB actually helped many of our employees during the time when they were struggling to pay the bills and to make ends meet. Where CERB certainly created a struggle for me specifically was it didn't matter how many hours you were working. If you, for example, so many of our part-time employees were only working a couple of days a week, and they were able to apply for CERB. So all of a sudden, their 2 days a week didn't seem like very much money in relation to getting $2,000 a month. So where we lost many of the part-timers inside of the industry. As of June of this year, there was 129,000 positions open inside of the hospitality market. Right now, according to the Canadian Canadian Restaurant Association, this has increased to 180,000 people that we're looking for. I was in Peterborough on business this week, and the McDonald's was only able to open there for drive-through. The reason why, they couldn't staff the inside of the restaurant enough, so they concentrated on the one area that they could. We see this locally at our Starbucks, the Tim Hortons and Aaron's, where they can't open the inside of the restaurant because they simply don't have the staff to support it and to manage it. As you can see, the leisure and hospitality industry was the hardest hit of all the major industries, featuring a 17% share of job losses inside of our market. I am a person who understands debt, but I also hate taking on debt with respect to something that was debt-free beforehand. The vast majority of the hospitality restaurants had to take on debt in order to survive. It was expensive to continue even though the doors are locked or even partially open offering takeout. Rent and utilities still kept having to be paid, and the restaurant industry lives on cash flow. So we buy today, but use the cash flow to pay it tomorrow. And when the doors were completely shut, there was no cash flow. So many restaurants actually closed their doors simply because they couldn't keep up with the cash flow obligations required to operate. Thank goodness we had provincial and federal programs to keep us running. These are the programs that were available to small business owners. The Ontario Small Business Support Grant, which was a grant, straight grant from the Ontario government. The Property and Energy Tax Rebate Support Grant, which was them offering to help pay hydro and electricity, which was also a peer grant. The Ontario Tourism and Travel Support Grant. And the one grant that was kind of flying under the radar was the Main Street Relief Grant. That was a grant that was only $2,500. And it was a grant that helped with technology. Basically, what it gave you the opportunity to improve your things like your website presence, your social media presence, and it also included hardware support. This program is still open and available right now, and I would absolutely recommend it. One of the considerations for the program for a small business owner is that you got to sit through a number of very, very informative seminars on what you could do to improve your social media presence and also your website presence. And I actually found this one very useful and a great tool for other small business owners. The federal programs that we all know about are the Canadian Employee Wage Subsidy Program, the Canada Emergency Rent Subsidy Program, and the Canada Emergency Business Account. I want to thank my friends at TD Bank for talking to me about the Highly Affected Sectors Credit Availability Program, which is HASCAP. This is a program available through the BDC. It's a very, very easy application process. And anybody who is in need of this program, I'd highly recommend to reach out to your TD rep and talk to them about using the program. A lot of concerns inside of the restaurant industry were the physical limitations with space. To say that the ball was moving all the time was a fair adaptation. We were constantly in a state of flux. We never really knew what was going to happen on any given day, and we dreaded when another announcement was coming available. Unfortunately, in the pub world, St. Patrick's Day is one of our biggest days of the year. On March the 16th, the day before St. Patrick's Day, I had a long, hard talk with my entertainer of the day, saying that we're heading into a bad time with COVID. What do you think we should do? Usually it's a packed wall-to-wall sort of people. We were discussing about opening the doors still, but limiting it only to people who had bums and seats. And when we awoke the next morning, March the 17th, the provincial government closed the door on us all. So our biggest day of the year, and you could imagine our biggest inventory that we carry at any one time, and the doors are closed. And there was no compensation for any of our inventory that we had. Any of the food that spoiled or went bad, insurance would not cover, and we were on the hook for it. So after that, we were closed completely. And then the first time that we saw some relief is you were closed completely, but you were allowed to do takeout. Then it started off that you're okay to open your patio. This is when the restaurant owners started to get cranky. They let us partially open, but only 10 guests on the inside. To operate a restaurant with only 10 guests on the inside when you have 5,000 square feet is one thing, but to operate when you're allowed 10 guests when you have a 150 square feet cafe is quite something different. To have a 5,000 square foot facility like mine is, and then to only be allowed to have 10 guests on the inside, didn't make it economically viable. So we just chose to keep the door open, the doors closed. Then they allowed us to reopen. So it was fantastic. They let us reopen the doors again. They gave us increased capacities. And then we were open for literally 4 days and had to lock the doors again. They closed us down again after just giving us an increased capacity. And we went through the process again. It started off with the patio, then it went to the inside with better capacity limits. And now, only in the last few weeks, we are actually able to fully open. Of course, COVID create physical problems on the inside of our space as well. We have PPE for employees, obviously mask, eyewear, and bubble wrap, I call it. And then we have hand sanitizing stations and customer safety obligations. We've had to purchase all new and improved chemicals with respect to COVID killing properties that are available to them. We've had to create workforce separation, not only customer separation, but workforce separation. We've had to hire additional staff just for cleaning tables between customers' visits. And we've had to create physical improvements on the property with solid barriers and such in order to make customers safe, so that we could keep customers, at the time it was 6 feet apart. Since then, we've gone back to a normal opening. It was reduced capacity for a long time. Technology, as I stated before, it was great that we were able to get the Main Street Relief Grant, and it actually improved my technology. I am probably, like most restaurant owners, one of the least tech-savvy people on the planet. As a matter of fact, it was a struggle to even come up figuring out how to do this presentation. But I say that I'm almost up to 2010 now. I figured out Facebook, and that's it. So what we didn't know about tech as a restaurant owner, lots and lots of people during the pandemic ordered takeout. There's a good, a bad, and an ugly associated with it. It's an awesome marketing platform because everybody gets to see your menu, and it's sort of a free form of advertisement. But I'm not sure that everybody's aware, website delivery apps like Yelp, Uber Eats, Skip the Dishes, they charge a minimum of 25% straight off the top that goes to the organization. So my beg to you is that if you are ordering from your local restaurant, call them directly, pick it up the same way, because they will appreciate not paying the 25% off the top. Also, part of the problem with website and delivery apps is that it creates, when your doors are open, it actually creates a problem for you. If tons of people are ordering through takeout, that means that your customers that are inside of the restaurant are actually having to wait for a little while. We were a big advocate of skip the dishes, and when we reopened to focus on our customer-based model, we chose actually not to go back to skip the dishes at all, and we are not offering any takeout except for calling us directly. Social media works. There's certainly positive and negative aspects to these platforms. You know, one bad review could kill a business in this day and age. We run restaurants, not technology. I know that more than best. So I have enlisted support from industry experts, marketing, and social media marketing firms. They run my social media, which is great, so that I don't have to. There's a really great company that I use called Duffer Media. Just a little toss out to them that have helped support me over the time. And anything that you could do with respect to social media or your website improvement has a compounding effect, which you wouldn't believe. It's hard to keep up to date on even your Google presence, or you have to keep everything up to date, and it requires a lot of work. Our modern age customer, what are they looking for? We know it's service. Customer service at a higher level. We need to train our staff to have the best customer service. People figured out that during the pandemic, they could stay at home and make food themselves or order online. So my recommendation is bring the water. By that, I mean, when a customer sits down at the table, it's always nice to have a glass of water sitting at the table, even before you begin to think about what you want to eat or drink. You have to make sure we're safe, clean, and COVID safe. I want to be the first choice of somebody's, if not at least the second. Customers don't want to go to your place every single day, but we hope that they can. We have to be social media aware. We have to make sure that we are responding to customers' queries and information on social media, and we have to respond in a timely manner. What are the expectations ahead? Well, takeout and delivery, dine-at-home trends will continue. Multi-unit operators will outpace the independents in the post-pandemic recovery, meaning that anybody that's a chain will have a purchasing power that will help them to exceed before the single individual restaurant. Quick service restaurants has led and will continue to lead growth in the near term. The McDonald's and the quick takeout restaurants are the ones that seem to be working the best. Full service restaurants will look to retrofit into smaller footprints, and big city metro locations will have a slower recovery in the customer base. Large menus are starting to go away, and because it needs a lot of labor to support them. And personal travel is expected to come back, but very slowly. We certainly have concern with the ability to staff up again post-pandemic, and labor for restaurants will be hard to come by. Buffets will be a thing of the past for a little bit. Key service that we have to focus on is service. We have to provide a service to get people to our restaurants, as opposed to them staying at home and ordering takeout. That's our key takeaway in the hospitality industry. As you can see by the bottom part of this slide, total sales. In 2020, we were at a 28.7 loss. We don't see us returning to a positive return to positive numbers until the end of 2023 with a modest 2% increase. What we did and what we will continue to do, we will cut our losses, cut our costs wherever possible, even though we're at bare bones already. The average profit in the industry when I first started was 10 to 12%. By post-pandemic levels, it had shrunk to about 5%. Where we're sitting at now is either negative or 0 to 1%, which is very, very tight, obviously. We have to have new models for pricing. We have to be able to be adaptable. We have to hire the best people, and it's been very difficult. And we have to pay the best people. So our cost of labor and our cost of operating business has gone up significantly. We plan for the worst, but we hope for the best leading into the future. Physical limitations. Many hospitality industries couldn't even open up when they gave you the opportunity to have patios. Simply, they didn't have the space to do it, and the models that they had put them out on the street corner. So if you're able to put a few tables out on your street, that was great. I was lucky enough that I was able to put a big marquee tent in the back of my place, and we put physical barriers in to have increased capacity on the inside. As I talked about technology before, if you haven't done so in your small business, totally recommend the Digital Main Street. Use your outside agencies. And TMT, I spend too much time on this area. The customer, stick to your strategy. Stick to what makes you the best in your industry, and make sure your staff follow the same guidelines. Innovation, adaptation, and survival. Many of my colleagues inside the hospitality industry did absolutely awesome. They were able to adapt and survive using different models. You can look to my friends at Deja Vu that created a wholesale market where many people still today actually go down and buy their chicken wings or their wholesale products instead of buying them from a big box store. I often get asked, aren't you worried? And I'm like, I don't know. Why? Would that help? At the end of the day, it doesn't help. What we should do is celebrate with some friends and have a small beer or two. And just keep trying to kick the ball. Anyways, thank you for your time.
Thank you so much, Perry, for sharing your story. We do have a couple questions here. One is more around the skip the dishes. So you had decided not to use skip the dishes. Is that something that you might reconsider in the future, knowing that it's going to take you 2 to 3 years to recover?
So the skip the dishes the model is great when you're operating currently, and a part of the problem is with skip the dishes taking 25% right off the top, you actually break even or lose money on every skip the dish order that goes out. And then what happens at the same time is that you're upsetting your customers that are actually inside of your restaurant. For the foreseeable future, I've decided not to offer skip the dishes and focus on the customers that attend the restaurant in person.
Perfect. It's nice to know that there's options, right? So moving down the line, we'll see what happens, but we wish you luck. You mentioned earlier in your presentation that there was 10,000 permanent closures. Does losing some of your competitors positively impact your business? And were there too many restaurants opened or operating pre-COVID? I'm not sure if this really relates to Orangeville, but in like maybe the sense of Ontario.
So globally, I could tell you that the restaurants that did fail, many of them were on the cusp already. The restaurant industry is a very hard industry to survive in, and it already has a very high risk associated with keeping the doors open. The 10,000 that closed the doors, many of them were on their way out already, sadly, and COVID just gave them that gentle push. With respect to, are there too many restaurants? People like choice. And in Orangeville specifically, Orangeville is a very big commuter town. And as a result, people do a lot of takeout, and people also do a lot of going out for dinner. I will absolutely miss some of the restaurants that have closed locally. Eat Like Sabi was one of my favorites that you wanted to go to for Mediterranean food, and I'll certainly miss the fact that they're gone. And it's sad. You don't want to see any of your colleagues close the doors. The restaurant community is actually a very small community, and for the most part, nobody wishes poorly on their colleagues inside of the industry. It's actually the reverse. We try to support each other, and so if somebody runs out of food, we'll lend it to them. So that's the type of industry that we're in, and I hope we stay that way.
Absolutely. It's nice that the community works together. I do have another question here. What do you think are the reasons that the hospitality industry is having such difficulty obtaining or paying for insurance? Is that more so because of the cash flow, or is that more so just it's hard to obtain insurance in that industry?
So that industry was hardest hit by insurance because many of the people who were underwriting the hospitality industry have chosen not to do so any longer. There were there's obviously concerns about people getting infected with COVID at one time inside of restaurants, and insurers did not want to have the risk associated with somebody getting COVID through a restaurant and potentially being sued. That was a big thing of it at the time. The hospitality restaurant insurance has been very, very difficult for a long period of time. And there are fewer and fewer people that are actually underwriting hospitality.
For sure. The most recent reopening, obviously, is making sure your clients or your customers are vaccinated. Has that impacted your employees at all? Have you lost employees because of that specific reason?
I haven't lost employees because of it, no. So it's actually been a fairly seamless process. The tools that we were given were, show your vaccination papers and show a proof of ID, and every single customer that seems to come into the door has it at the ready and is ready to provide that information. I think people are just happy to be ready to get out again and be inside of the community in a social setting again. Absolutely.
Well, I think that's it for questions today, Perry. I just want to thank you so much for joining us and for that insightful presentation. I've personally seen businesses struggle and strive throughout the pandemic, and your story today just demonstrates your strength and willingness to think outside the box, to face and overcome the challenges, and continue to grow no matter what. I wish you all the luck over the next 2 to 3 years as we see you get back into that positive status. And I commend you for everything that you have accomplished to date. And so I just want to thank you so much for being here with us. It was a pleasure to have you. And your technology was on point. So I
Thank you. It terrified me.
No worries. You did great. And we appreciate that so much. So that concludes today's event. On behalf of TD Bank Group, our speaker, James Marple, and the town of Orangeville, I'd like to thank you very much for joining us for the 2021 Virtual Orangeville Economic Outlook Summit. Thank you so much and have a wonderful day.